Well, it's interesting. The private debt asset class has grown enormously over the course of the last 20 years to the point where now it's really difficult to ignore. And I think there are reasons why it's going to continue to grow as the private equity ecosystem continues to grow. Returns have been very strong, and some of the dynamics of private debt are very attractive in today's uncertain, volatile times. Floating rate senior secured debt's a good place to be in the context of uncertainty about inflation and recession. Leaders in private debt have really been gaining share over the course of the recent period. You're right, there have been new entrants, but I think the bigger story has been the growing dominance of a small group of large-scale leading players. And those large-scale leading players have some really significant competitive advantages around relationships, around incumbencies. Those are positions that they hold as lead lender to existing borrowers, around scale, around expertise, around capacity to do a lot of different kinds of financings for private equity sponsors. So there used to be a very significant distinction between the private debt market and the broadly syndicated market. The private debt market used to be focused on smaller size companies, and the broadly syndicated market used to be focused predominantly on larger size companies. That distinction's blurred in the last couple of years, and we're seeing more and more larger companies choose to access the private debt market for, in particular, large-scale one-stop loans. Why is that? I think it's because those borrowers and the sponsors that control them really like the flexibility, the certainty, the capacity to grow, the confidentiality, and some other factors that private debt is able to offer that broadly syndicated markets aren't able to offer. So I'm not sure whether there will be a recession in the coming year or not. I think it's really hard to tell. There are very significant cross currents, and we're not in an environment that makes for easy predictions. Having said that, we may have a recession, and if we do, I think most of the private debt industry will fare quite well. Most of the private debt industry is focused on senior secured, top of the capital stack, floating rate debt. That portfolio construction provides a significant degree of resilience. Now, it also matters who your manager is. Some managers will fare better than other managers, and I think as part of a downturn, we're likely to see some dispersion of manager performance. I think that's going to be really interesting to watch in this coming period. So the private equity ecosystem has been growing very rapidly over the course of the last decade. Essentially, where the US economy used to be focused on public companies and family-owned companies, we now have a third kind of company in the system, private equity-backed companies. And that model of ownership is proving very powerful. It's been good for investors, producing strong returns. It's been good for companies. It doesn't have some of the disadvantages of public ownership or family ownership. And I think it's likely to continue to grow. If we look at the amount of dry powder that's available, uninvested committed capital that's in the private equity fund ecosystem today, that implies that we're going to see very significant growth in the universe of companies that are backed by private equity firms over the next few years.